Sarah Borkson-Keeter with NAREITs.com, and welcome to Quick Study, a monthly review of REIT market developments. I'm joined today by Brad Case, NAREIT Senior Vice President for Research and Industry Information. Welcome, Brad.
It's a pleasure.
So 2014 ended on a very strong footing for REITs. How did things look in the first month of 2015?
It was another very strong month for REIT investors. REITs were up 5.6% during the month of January. If you contrast that with the rest of the stock market as a whole did poorly during January. Large cap stocks were down 3% during the month of January. Small cap stocks down 3.25%. Small cap value stocks down more than 4%. And that's significant because a lot of investors have the misconception that REITs are like small cap value stocks. As I said, REITs were up 5.6%, whereas small cap value stocks were down more than 4%. If you look at longer term, you see that REITs typically outperform the broad stock market. If you take the last 10 years, for example, and that's a period that started not too long before the peak of the market for REITs. But over the last 10 years, REIT investors have seen total returns of nearly 10%, 9.93% per year for 10 years, and that 10-year period included the worst downturn in REIT market history. Whereas large cap stock returns were up only 7.6% over that same 10-year period.
And how were sectors performing in January?
Well, most of the REIT market did quite well during January. The strongest performing sectors were self-storage REITs, which were up more than 9.5% during the month. Healthcare REITs were up more than 9.25%. As I said, most of the rest of the market also did well. Retail was up 7.75%. There were a couple of segments that didn't do well during January. Mortgage REITs were down during January, almost by 0.5%. Lodging REITs were down very slightly during January. Infrastructure and timber REITs were up, but not nearly as much as the rest of the market. But as I said, mostly it was a strong market for all REIT investors.
Now, with REITs performing so well, there's been some discussion that they may be overvalued. Is that a view that you would share?
No, I think I can't say what's going to happen next month or the next 6 months, but I don't think it's very easy to make the case that REITs are overvalued, or I don't think it's very easy to support a prediction of poor performance for REITs going forward. And there are two reasons for that. One is that we've seen very strong news about the macroeconomic situation. And that means that demand for commercial properties, really of essentially all types, is likely to increase going forward. But investors have to keep in mind that what drives the real estate market cycle is really the differences on the supply side. And when we look at construction, really in pretty much every property type in pretty much every part of the country, we're still below even normal levels of new construction. So REIT investors don't really have any reason to be concerned about oversupply going forward. And given the strength on the demand side, REIT investors, I think, can still expect to see an imbalance that works to their benefit. You have to keep in mind that because of the supply side, the real estate market cycle is much longer than the stock market cycle. So I think maybe investors are thinking of REITs as following the same cycle as the stock market, which is on the order of something like 4 years. But that's not the real estate market cycle. The real estate market cycle is more like 18 years. And we're only about eight years into this market cycle.
Well, thanks very much, Brad.
It's a pleasure.
And for more news and analysis on all things REIT, be sure to visit REIT.com.